If you've been watching the silver markets, January 2026 will go down as one of the most extraordinary and most brutal months in modern precious metals history. We saw silver surge to record global prices near $120 per ounce, only to crash by roughly 30% from its peak in one of the sharpest single-day reversals since the Hunt brothers' collapse of 1980. But here's what most commentary is missing. This wasn't just a price story. This was a textbook case of market structure colliding with macro reality, and understanding why this rally is now over for the near term isn't about predicting prices. It's about reading the forces that actually move markets. What happened matters. Why it happened matters even more. And what comes next depends entirely on whether you understand that distinction.
Let's start with the facts. In late January, silver reached approximately $120 per ounce in global spot markets. That's more than triple where prices were just 18 months earlier. In any major commodity, that kind of move is rare. In silver, it's explosive. It was one of the most parabolic runs we've seen this decade. Then came the reversal. Within a single trading session, silver experienced one of its largest percentage drops since the 1980s. Roughly 30% of value was wiped out from peak levels in a matter of hours. This wasn't the kind of move you can explain away as routine profit-taking. This was the kind of volatility that triggers margin calls, forces liquidations, and turns paper gains into realized losses almost instantly.
This was not a normal pullback. This was a structural unwind. And the sheer size of both the rally and the collapse tells us something critical. We were not witnessing clean price discovery. We were watching a market that had become dependent on fragile forces, liquidity, leverage, and positioning, rather than being anchored to fundamentals alone. Before going any further, we need to separate two things that are constantly confused: fundamentals and market mechanics. Fundamentals change slowly. Industrial demand from solar panels and electronics, mine supply constraints, production deficits, these are long-cycle forces. They build over quarters and years, not days. And importantly, that fundamental story for silver has not suddenly collapsed. Supply remains tight. Industrial usage continues to rise. Structural demand tailwinds are still there, supporting higher prices over the medium to long term. But fundamentals do not produce 30% moves in a single day. Market mechanics do. Liquidity determines how easily positions can be entered or exited without moving price. Leverage magnifies gains, but it also magnifies losses. And sentiment, the collective psychology of traders, funds, and algorithms, can flip instantly when conditions change. January's collapse wasn't a rejection of silver's long-term story. It was a liquidity event, a violent one. So how did we get here? The rally didn't come out of nowhere. It began with genuine structural support. Silver's role in green energy, especially solar technology and electrification, has driven steady growth in industrial demand. At the same time, global mine supply has struggled to keep up. That imbalance created a tight physical market and a supportive backdrop. Layered on top of that was investor demand. Through late 2025 and into early 2026, macro uncertainty dominated global markets. Geopolitical tensions, persistent inflation concerns, and growing anxiety around currency stability pushed capital into hard assets. Silver, with its dual identity as both an industrial metal and a monetary hedge, became a prime target. But here's the crucial point. Those factors explain strength. They do not explain a vertical move to $120. For that, you need speculation. You need leveraged futures positions. You need options exposure. You need momentum traders and algorithmic strategies all leaning the same way at the same time. That's exactly what happened. The rally became a feedback loop of price chasing price. Fundamentals lit the match, but leverage poured on the fuel, and that combination is never stable. The reversal came when the macro environment shifted. Reports emerged pointing toward the nomination of more hawkish leadership at the Federal Reserve. The message was immediate and unambiguous: higher real interest rates, a stronger U.S. dollar, tighter financial conditions. For precious metals, that's a regime change. The dollar rallied, Treasury yields moved higher, and the macro tailwind that had supported silver turned into a headwind almost overnight. But the real damage didn't come from sentiment alone. It came from forced deleveraging. When a market is built on leverage, reversals don't happen gently. Traders who bought near the top using borrowed money were suddenly underwater. Stop losses were hit. Margin calls were triggered. Positions had to be closed, regardless of conviction. Selling wasn't a choice, it was a requirement. That's how cascades begin. One forced sale pushes prices lower, which triggers the next wave. Liquidity thins out, market makers widen spreads, execution prices diverge from screen prices. What starts as a correction becomes a rout. This is the reality of modern commodity markets. When risk appetite disappears and liquidity evaporates, declines accelerate faster than rallies ever did. Silver is particularly vulnerable to this dynamic. Its market is smaller and thinner than gold, oil, or major equity indices. Above-ground investment stocks are limited. Trading activity is concentrated in a narrow set of derivative instruments and exchanges. Under normal conditions, that structure works. Under stress, it breaks. Volatility in silver is not random. It's structural. When large positions try to exit simultaneously, there simply isn't enough depth to absorb the flow without severe price dislocation. Bid-ask spreads widen sharply, slippage increases, and prices disconnect from executable reality. Algorithmic trading only amplifies this effect, as momentum signals and volatility triggers reinforce downside moves. This is why silver rallies are explosive, and why silver crashes are brutal. Looking ahead, the key question is not whether silver's long-term story is intact. It is. The real question is timing. The most likely near-term outcome is consolidation, not continuation. The market needs time to digest January's extremes. That means choppy, sideways action rather than another parabolic advance. This does not imply a collapse back to $30 or $40. It implies a reset. Fundamental support remains, but fundamentals alone do not drive markets in the short term. Macro conditions do, and right now, higher yields, a firmer dollar, and tighter financial conditions limit upside momentum. What could change that? A renewed macro shock, escalating geopolitical risk, a policy shift that weakens the dollar, central bank actions that suppress real rates and revive inflation expectations. Any of those could reignite the move. On the downside, continued repricing of risk, higher yields, sustained dollar strength, or broader deleveraging across commodities could push silver lower as remaining weak positions are flushed out. For investors, the lessons are clear. Risk management matters more than predictions. No one can reliably forecast exact prices months out. What you can control is position size, leverage, and exposure to volatility. A long-term bullish thesis does not protect you from near-term drawdowns. Fundamentals matter over time, but liquidity and macro regime shifts dominate in the present. Watch real rates. Watch the dollar. Watch risk sentiment across equities and credit. These signals will tell you far more about silver's next move than any single demand statistic. This isn't about being bullish or bearish. It's about being realistic. Markets are nonlinear. Rallies end. Corrections happen. And the investors who survive are the ones who respect structure, understand mechanics, and manage risk accordingly. January 2026 was historic. A once-in-a-generation move that showcased both silver's potential and its danger. The rally is over for now. Not because the story failed, but because the environment changed. The reset is underway. The next chapter will be written by macro forces, not emotion. And the story, despite everything, is far from finished.